Hello everyone, welcome to Tesla Daily News. Today is July 5th, Saturday, and the following is the latest Tesla news. According to NBC News, Tesla's Autopilot and full self-driving systems are once again under intense scrutiny after a deadly crash in Katy, Texas. A Model 3 reportedly traveling over 70 miles per hour slammed into a brick home and killed 76-year-old Martha Avila as she was putting away groceries. The driver, Michael Butler, told investigators he was using Tesla's self-driving system at the time. He has been charged with manslaughter and is also being sued by the victim's family. According to the Northern Territory News in Australia and additional reporting cited by NBC News, Tesla's head of AI, Ashok Aluswamy, later stated that vehicle data show Autopilot had been manually overridden. He said on social media that the accelerator pedal was pressed to 100% in a residential area, and was still pressed during and after impact, with speeds reaching about 73 miles per hour, or roughly 117 kilometers per hour. Tesla is therefore positioning this as a case of driver override rather than a pure autopilot malfunction, while the victim's family is suing both Butler and Tesla, arguing that the driver assistance system still played a role in the fatal crash. According to NBC News, this tragedy has revived broader concerns from families affected by past autopilot-related crashes. Some see a repeating pattern: aggressive marketing of self-driving capabilities, insufficient safeguards, and confusion among drivers about the system's true limits. For investors, the legal and reputational risks around autopilot and full self-driving remain a key overhang on Tesla's valuation, especially as the company tries to pivot its narrative from being an automaker to being an autonomy and AI platform. Continued federal scrutiny and civil litigation could influence regulatory timelines, insurance costs, and the public's willingness to trust Tesla's software. According to The Motley Fool, Tesla just reported a record second quarter in terms of vehicle deliveries, yet the stock still suffered its worst single session in nearly a year. Tesla announced approximately 480,000 vehicle deliveries for the quarter, up about a quarter from the same period last year and more than 70,000 above Wall Street estimates. Deliveries also rose in a strong double-digit percentage from the prior quarter, marking a notable turnaround from the stagnation and decline seen in earlier periods. The article notes that despite this blowout delivery figure, Tesla shares fell roughly 7.5% on the day. Part of the explanation is classic buy the rumor, sell the news behavior. The stock had already climbed about a double-digit percentage in the weeks ahead of the report, and traders locked in profits when the headline number arrived. However, the deeper driver of the market's caution is concern over profitability and sustainability, not unit volume itself. According to The Motley Fool, Tesla produced roughly 451,000 vehicles in the quarter, about 28,000 fewer than it delivered. That gap suggests Tesla drew down inventory to hit the number, raising questions about how much of the quarter's strength came from end-of-quarter pushes or incentives rather than underlying organic demand. Investors are also watching Tesla's margin profile closely. In the first quarter, overall gross margin was barely above 20%, with automotive gross margin excluding regulatory credits under that. If the latest surge in deliveries was driven by more aggressively priced vehicles or promotions, margins could compress further. The report emphasizes that Tesla's lofty valuation reflects expectations for software-driven, high-margin revenue streams, not just selling more cars. At a very elevated earnings multiple, the market is clearly pricing in significant long-term upside from autonomy, full self-driving subscriptions, and robotaxi services. Against that backdrop, each earnings report is judged less on how many vehicles Tesla sold and more on whether those sales were profitable and whether the autonomy roadmap is progressing. The upcoming full second quarter financial release and management commentary later in July will be crucial for clarifying margins, pricing power, and the state of Tesla's autonomy ambitions. According to Bloomberg, as reported by the Swiss outlet Cash.ch, Tesla is pushing forward on Robotaxis but is progressing more slowly than some earlier promises implied, and is facing rising competition from Waymo, Baidu, and other players. Globally, fully autonomous ride-hailing is still in its early stages. Only a few dozen cities in the United States and China currently have commercial robotaxi operations, usually in restricted areas, and worldwide robotaxis make up a tiny fraction of total vehicles. According to this analysis, Tesla's vision is to combine private vehicle ownership with a networked robotaxi fleet, where owners can add their cars to a shared service when they are not personally using them. This would, in theory, allow Tesla to earn a high-margin software and services take rate on each mile driven, while giving owners a way to monetize their vehicle similar to listing a home on a short-term rental platform. However, this model depends on Tesla demonstrating robust safety, achieving reliable full autonomy, and navigating complex regulatory regimes in each jurisdiction. Bloomberg's coverage, cited by Cash.ch, highlights that other robotaxi operators like Waymo, Baidu's Apollo Go, and Amazon's Zoox are already running sizable test and pilot fleets. These systems typically rely on dense sensor suites including cameras, LiDAR, and radar, combined with high-definition maps and powerful onboard computing. While operators claim substantial safety advantages over human drivers, independent data are still limited, and recent incidents from sudden stops and traffic disruptions to misinterpreting school buses and emergency scenes have prompted regulatory reviews. According to the Bloomberg report, Tesla lags some of these rivals in fully driverless deployments. Musk publicly introduced Tesla's Robotaxi service in mid-2025, stating it was ready to operate broadly, but by mid-2026 the company was still running a relatively small mixed fleet of supervised and unsupervised vehicles in only a few Texas cities. In the San Francisco area, Tesla offers rides using its full self-driving supervised system, but still requires a human driver at the wheel, meaning it does not yet have regulatory approval there for true driverless operations. For investors, the key takeaway is that the autonomy race is real, but it may play out over a longer horizon and in a more competitive field than early Tesla messaging suggested. While Tesla has a large installed base and a massive driving data set, it also faces regulatory hurdles, the need for extensive safety validation, and increasingly capable rivals backed by technology giants. The upside scenario, where Tesla captures a material share of global robotaxi miles and layers high-margin software revenues on top of its vehicle fleet, remains one of the main arguments behind its premium valuation. But each delay, regulatory challenge, or competing deployment from Waymo, Baidu, or others can shift expectations about how much of that future Tesla will actually own. According to Blick in Serbia, citing Reuters, Tesla has launched a robotaxi service in Miami, expanding its autonomous ride-hailing presence in the United States. This rollout follows the introduction of Robotaxis in Austin during June, and the company is already planning further expansions to Dallas and Houston. Miami is a strategically important metro area with dense urban traffic, tourism, and a strong ride-sharing market, making it a significant testbed for Tesla's full self-driving-based robotaxi vision. The report notes that this move is part of Elon Musk's broader strategy to shift Tesla's growth engine from pure vehicle sales toward artificial intelligence, robotics, and autonomous services. As Tesla extends its robotaxi network, it aims to monetize software through per-mile fares and subscription models, potentially achieving higher margins than traditional car manufacturing can provide. At the same time, Tesla is competing directly with Alphabet's Waymo and Amazon's Zoox, both of which are also scaling robotaxi operations in multiple American cities. According to Blick, Musk has recently suggested that fully autonomous vehicles without safety drivers could become a normal sight on U.S. roads by the end of the year, although whether regulators and safety data will support that timeline remains uncertain. For investors and enthusiasts, the Miami launch is concrete evidence that Tesla is moving from promises to actual deployments, even if the scale remains limited. Each new city provides real-world data, regulatory experience, and user feedback, helping Tesla refine its technology and business model. According to the Slovenian daily Delo, Tesla is experiencing a strong rebound in Europe despite political controversies surrounding Elon Musk and a limited model lineup. The article notes that after a period of negative public reaction, particularly in Germany, to Musk's outspoken political positions and criticism of subsidies, Tesla's sales figures in Europe have climbed back to roughly their levels from 2 years ago. This recovery is happening in a market that is increasingly crowded with electric vehicles from both traditional automakers and new challengers. Delo reports that Tesla's European factory near Berlin, known as Gigafactory Berlin-Brandenburg, is planning to expand production and increase headcount. This suggests that regional demand has recovered enough to justify additional capacity and investment. For investors, this matters because Europe has been one of Tesla's most important markets outside the United States, and earlier slowdowns raised concerns that competitive and political headwinds could structurally erode Tesla's share. The article frames this rebound as somewhat surprising given that Tesla has not flooded the market with new models, relying mainly on its established products while many rivals introduce fresh offerings. Yet the company still managed to regain momentum. This indicates that Tesla's brand strength, charging ecosystem, software features, and cost structure remain competitive advantages in Europe. It also suggests that while political controversies can temporarily hurt sentiment, they have not permanently derailed demand. According to the Croatian outlet Novi List, Tesla faces a more challenging demand backdrop in some markets, with indications that the electric vehicle segment may be approaching saturation in certain areas. The report, citing The Guardian, states that Tesla recorded a year-over-year decline in vehicle sales in the second quarter, feeding into worries about slowing EV adoption after years of rapid growth supported by subsidies and regulations. The article notes that competition from Chinese manufacturers and European legacy automakers is intensifying. Many rivals are offering aggressively priced models, putting pressure on Tesla's volumes and margins, especially in Europe and China. As more automakers bring a wider variety of electric vehicles to market, the early adopter phase is giving way to a more price-sensitive, mainstream customer base. In that environment, Tesla must balance pricing, cost efficiencies, and product innovation to protect its position. According to Novylist, this slowdown is not just about Tesla itself but reflects broader industry dynamics. Some governments are tapering incentives, charging infrastructure build-outs are uneven, and consumers are weighing total cost of ownership more carefully. For Tesla investors, this raises the importance of cost optimization, localized production, new model introductions, and software-driven revenue streams to offset any plateauing in unit growth. According to the Turkish business newspaper Dünya, a Tesla Cybertruck used intensively as a commercial ride-hailing vehicle in the United States has attracted attention due to its high out-of-warranty repair bill. The owner, who drives for a mobile ride-sharing platform, reportedly logged around 160,000 kilometers in about a year with a 2024 Cybertruck Foundation Series dual-motor model, spending an average of 7.5 hours per day behind the wheel. The report states that the vehicle's tires were replaced with Michelin Defender Platinum LTX units at a cost of roughly $2,500. The more significant expense came from upgrading the truck's power conversion system from an older revision to a newer one, a procedure that cost about $7,200. In total, maintenance and repair expenses exceeded $9,200 once the warranty period had ended. According to Dünya, the owner shared his experience online, remarking that Tesla service costs can rise sharply once the vehicle is out of warranty. This sparked fresh debate among high-mileage EV owners about long-term maintenance, component durability, and the real cost of ownership beyond the warranty window. For investors, this anecdote is not a full data set, but it underscores that Tesla's long-term economics will also be judged on reliability, service experience, and residual values, especially as the brand pushes into commercial usage and high-utilization scenarios like robotaxis and ride-sharing. According to Norwegian broadcaster TV2's automotive segment, Tesla has introduced a 7-seat version of the updated Model Y in Norway, one of its strongest markets. The Model Y Premium long-range all-wheel drive with 7 seats comes at a higher price than the 5-seat equivalent, with a roughly 40,000 kroner premium. The vehicle adds a third row of seats and sliding functionality for the second row to improve access and flexibility. The report highlights that despite the extra seating, Tesla has managed to preserve a decent amount of cargo capacity thanks to a deep underfloor well in the rear and a sizable front trunk. When the third row is folded flat, the space approaches that of the 5-seat model, and the ability to fold individual seats allows for flexible arrangements of passengers and luggage. The trim also includes features such as long-range capability, all-wheel drive, premium audio, heated and cooled front seats, heated rear seats and steering wheel, a panoramic glass roof, and an 8-inch rear display with integrated climate and entertainment controls. For Tesla enthusiasts and investors, the 7-seat Model Y is an incremental but meaningful product enhancement. It broadens the vehicle's appeal to families needing extra seating and helps Tesla defend its leading position in markets like Norway, where the Model Y has been the top-selling car. Small product updates like this, combined with regional configuration tweaks, can sustain demand and improve mix without the cost and risk of entirely new platforms. According to the Ecuadorian newspaper Expreso, opinion writers are also linking the recent Texas Autopilot-related fatal crash to Tesla's broader political and policy footprint. The commentary revisits Tesla's prior recall of over 2 million vehicles in 2023, which was triggered after several fatalities and regulator findings that the Autopilot system had not done enough to prevent misuse and accidents. It then criticizes Elon Musk more broadly for his influence on U.S. foreign aid and domestic subsidy policies, arguing that his positions and lobbying have had real-world consequences beyond the automotive sector. While this is an opinion piece rather than a straight news report, it reflects how Tesla's brand and Musk's persona are perceived in parts of the global media environment. For investors, such commentary matters to the extent that it shapes public sentiment, regulatory appetite, and political risk. Persistent negative narratives, especially on safety and ethics, can influence how quickly regulators approve new services like robotaxis, how eager cities are to host pilots, and how comfortable consumers feel trusting their lives to Tesla systems. Taken together, this week's Tesla news presents a complex picture. On the positive side, Tesla has just delivered a record quarter in unit terms, is rolling out Robotaxis in major U.S. cities such as Miami and Austin, and is showing a strong sales rebound in Europe with expansion at its Berlin factory. Product updates like the 7-seat Model Y in Norway extend the company's lead in key EV markets. On the more challenging side, the stock has sold off despite the delivery beat due to worries about margins and demand quality. Tesla faces intense competition from Chinese and European rivals, and serious safety and reputational questions persist around Autopilot and full self-driving, especially after the fatal crash in Texas. For long-term investors and enthusiasts, the central questions remain: can Tesla sustain or restore healthy margins in an increasingly crowded EV market? Can it successfully transition from a car manufacturer to a software and services-driven autonomy company? And can it do so while convincing regulators and the public that its technology is safe, reliable, and worthy of trust? The answers will unfold over the coming quarters as financial results, regulatory decisions, and real-world performance continue to shape Tesla's trajectory. Thanks for listening to Tesla Daily News. If you enjoyed this episode, please subscribe and stay tuned for the latest updates on Tesla and the future of electric vehicles and autonomy.